All right, let's see here. Let's turn some lights on. All right, everybody, we are live. Let me just get my stuff set up here. Awesome. So we are live. So welcome back to Dapp University. So today we are going to talk about a big problem for crypto that needs to get solved ASAP in order for this space to really work out and flourish over the long term. And I think it's a problem that can be solved. So I'm talking about the path to doing that in this video. We're going to talk about that. We're going to look at a lot of other updates that have happened in the space since yesterday. Again, we do these live streams Monday through Friday on this channel. Just subscribe, turn on notifications. You're going to find out about those whenever we go live. We're going to answer some of your questions and a whole lot more. So if you're new around here, hey, I'm Gregory, and on this channel, I turn you into a blockchain master. So if that's something that you're interested in, then definitely smash that like button down below for the YouTube algorithm and subscribe to this channel. And if you want to know how to master blockchain step-by-step start to finish, then head on over to dappuniversity.com/bootcamp to get started today. All right, so we got people jumping in the chat here. We got technically Cody. Let's see here. Hope I'm saying this. Zelko. Hope I'm saying that right. All right, we are live. I like that. Above Realty, Cryptechology, Ardal. Let's see here. Be Known, Imagining. Welcome, welcome, welcome. So let's see. We'll let people jump in here for a second. I think it's taking a minute for YouTube to show the live stream to other people. But yeah, so let's go ahead and jump into this. Let's talk about a big problem for crypto that needs to get solved and some updates about this, okay? Let me just pull this up on my screen here. Well, first of all, I don't know if anybody saw the stream yesterday, but we got cut off right as it was kind of getting to the good part. And my system like instantly froze and collapsed. So I don't know if that was a total coincidence or if somebody somehow got inside the machine and started, pulling the levers. Basically, I started talking about the inflation measurements and how, the sort of the definition of the inflation measurements as defined on sort of the White House website is somewhat different than what a lot of people use to measure inflation. I know there's just disagreements about that, and everybody says you can just use the 2-quarter rule, but it was a little a little uncanny that my system just crashed and the video ended right at that point. So definitely go check out that if you haven't already. But anyways, let's go ahead and jump into this. Let's talk about. Yeah, it says no, do not go visiting that website again. All right, so let's talk about this. Let's talk about a big problem for crypto. So, crypto absolutely, Web3 blockchain technology has such insane potential to completely change, the internet as we know it, creating an internet of value. But we can create so much of technology, but there's a lot of territory that's really off limits in a lot of ways. And there's a lot of, for this reason, you have a lot of people that are essentially holding back from, getting into the crypto space, whether that's institutions or other people who actually want to buy crypto assets because fear of crypto regulation. Okay. So basically, think about it this way. You can do so much with crypto tokens, all right, to create an internet of value, to create, new applications that have tokens built into them to create economic incentives. You can do things with NFTs to create, intellectual property rights for anything. We have this internet of value where you can do all this on the blockchain, where you can have non-custodial ownership over so many things that you can't do in the real world. Like I was saying before, you could take an entire music catalog and make the intellectual property rights an NFT and then automate a lot of that process that's really hard to do now. You could take the equity in any company and instantly tokenize it and open up, all kinds of new potential for what you could do with those types of use cases. But just because you are able to do something with technology doesn't mean that you are necessarily allowed to do that. And we have so many from a legal and regulatory standpoint, and we have so many projects that already exist in this space that are kind of online, okay, or in a gray area, or obviously in a not so gray area, but a black and white area, and in violation of those things. That's really holding back a lot of big legitimate players from buying into the space and actually participating. And so, one of the major problems with crypto in this regard is basically having some of this regulatory clarity on what is and what is not valid, okay? And then also trying to set some sort of common sense framework to see what people can actually do. So let's take a look at that. So we have some updates on that in the space. We have several different things. The first one, let me just pull this up here. Let me just pull it up here. I lost my tab here. So anyways, we've got several different things that are popping up on the regulatory front that are all kind of converging at one time. That's one reason I want to talk to them all at once. Okay. So the first is this. So basically, the SEC is providing regulatory clarity, just not what anyone wants. So we saw this kind of pop up over the past couple of days with Coinbase. Basically, Coinbase had listed a lot. First of all, Coinbase kind of been in the spotlight for several reasons lately. There were some allegations of insider trading happening at Coinbase that were kind of like blowing up like crazy. I didn't have all the details on that type of thing. It's not the kind of thing I really want to focus on without knowing exactly what's going on behind the scenes. Okay, but that they've been in the spotlight for that reason. Another reason is that basically. The SEC sort of stepped in and was calling a lot of the assets that Coinbase had listed under the certain time period as securities. Okay, so that's kind of the perspective here. We talk about people wanting regulation in the crypto space for a long time, and the opinion here is the SEC is providing regulatory clarity, not just how anyone wants. Now, I want to step back and also say, like, my stance on crypto regulations in the first place. I think crypto can exist just fine without a lot of regulations. Okay. It has basically already for a long time. I'm a realist in understanding that regulations are inevitable for this space. Okay, and the best thing that we can shoot for is basically regulations that are the most favorable for the space, and that's probably the best we can hope for. And the other thing is that, like, once we have sort of regulatory clarity on a lot of things, it's going to ease a lot of people's minds on what you can do with crypto, and it's actually going to encourage more people to actually participate in the space, in my opinion, okay? Because at the end of the day, like, think about a lot of people who are big players, lots of capital sitting on the sidelines, who are basically saying, like, hey, this crypto thing looks like it's the future, but, the last thing I want to do is deploy capital to a space where, regulations get slapped down, where, one, it could limit access to the capital that I've put into the space, the ecosystem, or number two, it could essentially, cause, it could affect who can participate in the space in the future, or just like panic and spook everybody where the value of the capital that I've put into the space actually goes down, or I lose it completely because, of what's possible with a lot of other people in the space. So, that's definitely something that I think is good. So anyways, one perspective is the SEC is actually providing clarity on some things. And basically the whole idea here is that, a lot of these tokens are getting classified as securities. And that's likely to be the case for many other tokens in the future. Okay. So, one really important thing to understand is, there's always been a lot of fear about things like major cryptocurrencies like Ether being a security. There's a lot of FUD about this floating around online. We've seen lots of comments to basically suggest that we don't want, or basically that it's very unlikely that Ether is going to be regulated as a security. Okay, that would be under more the jurisdiction of the commodities. Okay, or treated as such. So I don't have a lot of fear about something like that. But, basically, I think what we're seeing here in terms of regulatory clarity in the short term is anything that essentially is a token that, is listed just like the ones we see in this list are most likely to be classified as securities and should be treated as such, unless there's a strong indication to think otherwise. So that's the first thing that's the first assumption that I would always go with if you're looking at, new projects and whether they might be regulated under the SEC or not. Okay. Now, one good thing in terms of crypto, regulations, one positive development, it's kind of a negative thing. I'll talk about a positive thing that I saw pop up is basically we saw this, U.S. senators are pushing to make a bill to make small crypto transactions tax-free. So basically this senator on the Senate Banking Committee joined to exempt transactions less than $50. Okay, so actually, this is not the first time we've seen this type of thing, where essentially we're setting a maximum threshold for crypto transactions before you have to pay taxes on them. And this, honestly, I think this is a really good thing that can help the adoption of blockchain technology, cryptocurrency, all that type of stuff, because taxes can be a pretty cumbersome thing when you're talking about actually using cryptocurrency. Okay, so there's so many different things you can do with crypto, right? You can buy it and hold it. You can trade it. And like whenever you trade it, you pay capital gains tax. Whenever you make a profit and you actually realize that gain. I think that's expected for a lot of people, especially in the United States. I know there's countries out there that do not tax capital gains, or maybe they don't tax crypto gains, all right? Or there's different provisions, okay, depending on where you live, or maybe the amount of time that you hold the actual asset itself. But I think, at least in the United States, okay, there's lots of the expectation is that you're going to pay capital gains tax if you are trading crypto in some way, whether that's short-term capital gains or long-term capital gains. Now, the really tricky part is if you're dealing with cryptocurrencies that any type of volatility associated with them, and you're actually using it to pay for things, then that can be a real limiting factor. Okay, so let's say that you held some Bitcoin. Okay, you want to go buy a pizza with Bitcoin. Like, that's the famous example of the guy who spent, like, I can't remember how much money on a pizza with Bitcoin, like a decade ago. Now that pizza's worth like $200 million or something. I can't remember what the numbers are, but something astronomical. But let's just say you did it in today's times. Let's say you had some Bitcoin and you wanted to, Venmo your buddy, $50 for, a night out or something, right? Anyways, unfortunately, like if you bought your Bitcoin and the price went up, like technically you'd be on the hook for capital gains tax on the difference. All right, you essentially realized a gain at that point. Again, I'm not a tax expert, but those are the rules that I play by. Okay, and that's my understanding of the tax code here, at least here in the U.S. So that's super limiting because, like, who wants to go say, all right, I'm gonna go buy a pizza, and then, all right, okay, I spent $30 on this pizza, and I spent like 0.000001 BTC or whatever it is on that pizza, and then I have to go back and do the math and realize that I paid like $10 for that Bitcoin, a couple of years ago. And now like I paid $30 for this pizza, but I also technically owe the IRS like, $4 in capital gains tax. Right? I'm just doing loose math off the top of my head, right? It's not necessarily how it would add up, but like that's a huge pain. So the big benefit here of something like this is that, like, if you're making transactions that, at the time of the transaction is less than $50, then you would not be liable for capital gains tax in that sense, okay? So, like, that would be really big because that completely enhances the value proposition of using cryptocurrencies as a payment mechanism, okay, especially for everyday things. Now, I've seen this number kind of go up and down. I think I've actually seen this like to the $200 level. I'd like to see it closer, something like that, within a $50 level. But if we could get this to the common sense threshold of like, several $100s, maybe $500, even $1,000, that's gonna really change the utility for actual cryptocurrencies as a payment mechanism themselves. Now, I realize they probably want to keep the threshold low because the last thing they want to do is somebody to, make like, 7 figures worth of crypto gains and then, do a bunch of microtransactions to somebody else to like, try to evade capital gains tax. And the higher the limit is, the easier that is to do. So that's probably one of the reasons the limit's actually low. But, like this still a step in the right direction. Still a step in the right direction, in my opinion. So another big worry for the space in terms of regulatory clarity is with stablecoins, okay? Because, stablecoins have been, they've had a lot of attention in crypto lately, I'll put it that way. We've seen like the Terra Luna stablecoin disaster happen earlier this year, which corresponded to some major downturns in the crypto markets. Of course, what's been happening in crypto for the past 6 months has definitely been, first and foremost, led by the broader economy, all right, led by this economic policy shift by the central bank, basically raising interest rates, tightening monetary policy. Okay, that's been affecting pretty much all markets, not just crypto markets themselves. But we've had our own crypto-specific issues that have exacerbated the downturn. Okay, we've seen funds blow up, insolvency issues. But one of the major things was, the Terra Luna stablecoin, algorithmic stablecoin, absolutely blow up. Not the first algorithmic stablecoin experiment that we've seen blow up, but it was one of the biggest ones ever. I mean, it was a major crypto. The Terra ecosystem was on a website like CoinMarketCap, CoinGecko. I think it was in the top 10. I can't remember off the top of my head, but anyways, not all stablecoins are created equally though. Okay. But stablecoins put a bad taste in people's mouth. There's a broad fear across stablecoins. They're not all created equally. We're talking about collateralized stablecoins. We're talking about stablecoins that are actually backed by cash equivalents, maybe some different cryptocurrencies. Okay, and one thing that I think a lot of people are waiting for in terms of crypto is regulations around the stablecoin space, because the last thing people want is basically like a cryptocurrency that consumers think is supposed to be, pegged to a certain thing, where they can always redeem their assets for something else. Okay, because that's the promises of stablecoins. So people say, how do you create a stablecoin all the time? Well, theoretically speaking, you have an issuer, and you should be able to go to that issuer and buy the stablecoins with, whatever type of asset it's pegged to, or at least a one-to-one value transfer. And then anytime that you want to get your stablecoins back, you should be able to go back to the issuer and then, redeem those stablecoins. Now, I think the big concern here is lots of things. Algorithmic stablecoin blow up like we saw with Terra Luna, but also basically like a bank run where, the fear is that these stablecoins don't actually have all the assets and reserves that they say they do, or couldn't provide the liquidity that they say they're going to in time of a crunch, okay, or a bank run. So example, let's say the stablecoin had $100 million market cap. That's a pretty small in the grand scheme of things. Let's use it for, example purposes. Well, theoretically speaking, if theoretically speaking, if everybody, if the entire, let's say the entire circulating supply is, currently $50 million, all right, well, theoretically speaking, if all $50 million worth of that value wanted to go back and redeem it instantly, it theoretically should be able to. Now, that's where the problem lies, because they don't expect that to happen at all. That was sort of the problem with a lot of the bank runs that happened in the past was, hey, we got this we're starting this fractional reserve banking thing now. Well, that's not the issue with the original, with the big runs that people are talking about with, that happened right around the Great Depression, right? That was before we actually had that type of system in place. But the whole idea was still the same issue with private banks, where you're lending out more than you actually have on hand, okay? And then basically people try to come back and redeem that amount, and then it's not there, and then it's just you're in trouble. So that's the type of regulation I think people are waiting on for stablecoins to see what's going to happen. If we say that, hey, you can only operate as a stablecoin legitimately within this jurisdiction under X, X, Y, Z conditions, what are the rules that you have to play by in order to be, a regulated, accepted stablecoin? And so it looks like we are moving in that direction. So U.S. stablecoin bill delayed, but draft language may soon emerge. So basically, as negotiations slow the release of a bipartisan bill until possibly September, lawmakers may put out some initial language soon to spur further discussion. So it looks like we could start to see a move in that direction within the coming months, okay, to actually get some type of codified language for how stablecoins are to be regulated within the United States. We've seen effort applied on this for quite some time now. I think that effort is likely getting accelerated based on what happened with the Terra Luna disaster earlier this year. Okay, and it looks like within a matter of a couple months we could see that type of thing. And so that's gonna be a big coincidence with if that timeline actually works out, like that's going to coincide with another big event that we've got coming up with the calendar in just 2 short months, which is the Ethereum 2.0 merge. Okay. So again, don't forget, we got the ETH 2.0 merge slated for September 19th. This is where Ethereum switches from proof of work to proof of stake, where miners get replaced by validators, and then you can now stake your ETH natively on the network. Okay, that's also going to be when ETH becomes a deflationary asset. Okay, you're going to be burning more ETH than is actually created by the blockchain because ETH's going to undergo the triple halving, where basically the ETH supply, instead of being about a 4% annual issuance, it's going down from 4% down to 2%. That's one halving. 2% down to 1%. That's the second halving. And then the second, like 1% down to 0.5%, which is the triple halving. And then assuming the network activity stays the same, then, more ETH is going to be burnt on a moment on an annualized basis than is going to be created. You can see that like on a website like here, like Ultrasound Money, where basically like you can see how much ETH is getting created right now. Right now, we're creating 5.5 million Ether per year. We're burning 0.9 Ether per year. Right now, it's a 3.8% annual inflation. Right, it would be about 4% if you took out the burn. Okay, but if you factor in the merge, all right, then on a 1-day timeline, that's going to be minus 0.2% inflationary, or it's a negative issuance, okay? And, if you zoom out on a broader timeline, okay, like you do all, then that puts you like minus 1.7% deflationary. And so you have to look at this like on a different timeline. Like it's not necessarily going to be deflationary on a block by block basis, okay? So you can see like every new block that's mined, you can see how much ETH is burnt, okay? But anytime you have blocks that are like north of 2 ETH, that's going to be a deflationary block, okay? So when the network activity is slow, then, it won't be as deflationary. But like on a 1-day timeline, you can still see that even on a slower day, we're still in that negative issuance territory, okay? If you play with it, on different time frames, like you can see the hourly, see the daily, see the 7-day, which is neutral basically, but 30-day, and then all are definitely deflationary. The bigger picture here is you want to look at on an annualized basis, because network activity can go up and down, but it's still pretty significant. So it's a good question. So as ETH becomes deflationary, will it keep having its issuance similar to Bitcoin, or will it steady at 0.5%? How will that continue to work? Yeah, it's a good question. So basically, we're not going to. Basically, you're not going to continue having the issuance. So it's not like Bitcoin where you go have a new halving every 4 years. Basically, the triple halving is going to occur once at the time of the merge. So it's a great question. Somebody says basically, are we going to see any type of significant programming procedure for devs with the merge upgrade? No, not really. Most everything should work unless you are doing developer interactions that specifically have to do with proof of work mining things like difficulty. If you're trying to get the block difficulty or something with the RPC call or something like that, then like you're probably not going to have to do anything to change for the ETH 2.0 upgrade for the merge. So, I mean, basically, if you'll know if you're doing that type of stuff inside your application. All right, so let's take a quick peek at the crypto markets here. So we definitely got red on the charts all across the board here. All right. So, I don't think there's any, let me just pull up my advanced chart here. I don't think there's any question that the reason we're seeing red on the charts today is because of the major events on the calendar that we talked about yesterday. So again, yesterday we talked about what to watch out for in crypto this week, that we should see some volatility. And we are already starting to see that volatility here. Okay, Bitcoin's back at the $20,000 level after getting up to $24,000 level last week. Okay, we're already starting to see volatility to the downside. So what are the major events on the calendar this week that we're watching out for? Well, it's the Federal Reserve is meeting, okay, and we're going to find out what the next interest rates hikes are going to be. Is it going to be in people's expectations of a 75 basis point hike, or is it going to be higher, or is it going to be lower? Okay, and we could see volatility, sort of in line with either of those directions, to the downside if it's worse than people's expectations, or to the upside potentially if it's better than people's expectations. So right now, it looks like markets are telling us something doesn't look good. So who knows if anybody has any inside information on what it's going to be. But the other two big factors, of course, the tech earnings. Okay, we're already starting to see tech earnings come out. Let's just see if anything's hit Twitter since I've been live. It's like things have gotten a little worse since I even hit the stream button here. I don't see anything off the top of my head here. But the other big thing is definitely the GDP numbers. So this is where the stream went down yesterday. We're talking about this. We've got GDP numbers for Q2 of 2022 are supposed to come out later this week. Again, we measure gross domestic product every quarter, and it's slightly delayed. So, we finished the quarter out at the end of June, and we should get the GDP print, I believe it's Thursday. Okay. And so that's gonna let us, that's where we're gonna find out whether we're in a recession or not. Okay. And this is where the stream went down yesterday. Classically, the recession is defined as two consecutive quarters of negative GDP print. I know I see lots of arguing going around online with hey, that's not the official way to measure a recession. That's the rule that a lot of people use. Okay. I've seen the Goldman Sachs report, all that type of stuff, the language on the White House website. I get that. But that's classically the rule that a lot of people use, and that's the one they're going to run with whenever we find out whether we got a negative GDP print or not. Because if we get another negative GDP print, we saw a negative one. We saw a negative GDP print in Q1 of this year. If we get another quarter of negative GDP print, there's going to be lots of people waving the recession flag. People already are, okay? But if we have that piece of data come out, then it's gonna. I think it's going to send people into a little bit of a panic, okay? And it's hard to know exactly how the market's going to take that. I don't think it's going to be good by any stretch of the imagination, but if it has downside, it's hard to know exactly what that downside is going to be. But yeah, definitely keep an eye out that for this Thursday. So, we could have some information about that already starting to circulate in the markets. We just don't know until us normal people find out what it actually is. So let's see here. The other thing to watch out for is how is crypto correlated to other markets. Like right now, we got the NASDAQ 100. It's also taking a dip. Okay. Pretty much since Thursday. And looks like we're seeing some correlation in the crypto space in that regard. So it says Google's earnings will make the sell-off worse. It might. Wendy couple. Sure would be nice, wouldn't it? All right, everybody, that's all I got for today. As always, smash that like button down below for the YouTube algorithm. Subscribe to this channel if you haven't already. That really helps these videos out so that more people learn about blockchain. And if you're as fast with this technology as I am, you want to get your hands dirty, how can you get started today? Well, you can go to my YouTube homepage. You can find those free courses there. They're like Udemy courses, but they're totally free. And if you like those and you want to take the next step, or hey, maybe you want to take a master shortcut entirely, I can master blockchain step-by-step start to finish over at dappuniversity.com/bootcamp. You have to be an expert to get started today. Help people with zero coding experience become real-world blockchain developers in a matter of months. So that's all I've got. Until next time, thanks for watching.